not taught how money works. In fact, we're taught to help other people make a lot more money at the sacrifice of ourselves. I always say that it's nice to pass money on. That's great. But what is more important? What is more valuable? It's the knowledge of how the wealth was created in the first place. Infinite banking, it's actually a way to guarantee generational wealth, and it's tax-free. But also keep it in mind that this is not just for next generation. It's also for when you are living, this person can use the cash value to create other wealth, do other things with it, to fund businesses, fund investments, fund their lifestyle, whatever they want, right?
Welcome back, everybody. Our weekly show, Wealth Webinar, where we bring you the secrets of money. And most specifically, we show you how to take back control of your money by teaching you how to be the bank. Today, Stephen and Brian are going to just knock it out of the park today, because we're not going to talk about you. We're going to talk about your kids. But you're involved, just so you know. And I think that's a really important thing to bring up is our children learn what they learn. They develop the habits they develop by watching us, what we do, how we do it. If we go through life doing all the things we're told to do with money, that's exactly what our kids are gonna do. They're gonna do the exact same thing. But if we teach our children how to change where their money goes, how to be in control of their money, and how they can control their own banking system and never need to rely on traditional banks for anything other than putting money in and taking money out of a bank account and maybe a mortgage here and there, then they would be in a much better place. Well, that's exactly what today's topic's going to be. So I'm going to turn this over to Stephen and Brian, let them rock this out. Maybe I'll put a couple words in about Vivi Lucky Jeans and what I've done for her, but take it away there.
Yeah, man, good stuff, and definitely looking forward to this with our money mentor Brian Fouts. So if you're new here, just put a 1 over in the chat box. We'll see who's brand new to Wealth Webinar, your first week. Maybe you've been on like one previously. Just put a 1 in the chat box if you're brand new here. Let me just see who we're working with. I know a lot of you already chatting in there. Very familiar names. You guys have been around this campfire for a lot of you several years at this point, and following along, continuing to get educated every single week. So if you're brand new here, what we teach is how to take back control of your money and solve your money problem. And this is developed over a couple of decades of being around financial education. Myself and Chris both come from a formal financial background as far as being financial advisors, fully licensed, and the traditional route of recommending things like investing in a 401k and using investment management and IRAs and saving money for the future and things like that. And what we do now today is very similar, just in a much more smart way. We teach what the wealthy do, what the banks do, and how to really change one thing to change everything with your financial situation. And that's what we call the infinite banking concept, also known as becoming your own bank. So if you're brand new here, this is not going to be your basic training. We do have what we call the 90-minute infinite banking training that we can post a link. You're definitely going to want to check that out if this stuff's new for you. But what we are going to talk about today is how we can start controlling our wealth, creating a banking system, not only to take advantage of today for our lives, but how do we start looking at the future? How do we start looking at our children for creating a legacy, for creating multi-generational wealth? And here's a little secret that most people don't want to tell you. It's not hard to do. You can use a couple pretty basic vehicles, instruments. If you set them up properly today, change your mindset just a little bit, you don't have to change anything else you're doing right now. And the trajectory for you, your family, and your legacy is going to be completely different. And that's the beautiful thing about what we teach is you literally just change one thing and that changes everything. And that's where your money flows first. So we'll get into some of that stuff, but I want to make sure we have enough time with Brian Fouts and what we want to get into today. So let me just set the stage and I'll introduce Brian and we'll dive right into this here today. So we're going to talk a little bit about what destroys generational wealth. And basically that's what most people do. If you guys have seen me teach any classes before, I always talk about the 3 wealth killers. taxes, volatility, and inflation, and how those can work in conjunction with each other just to make most people poor not be able to retire and live the lifestyle that they want to live, which is just insane in the richest, country that's the world has ever known, in the United States of America. There's so much opportunity here. So we're going to talk a little bit about what typically destroys generational wealth so we can understand what mindset changes need to be made to be able to create generational wealth. And like I said, the good news is this stuff is not hard. This is stuff that we do every single day, and our clients love us for it. And those of you that are on right now, if you've been around our campfire, if you've implemented some of these strategies, used some of these vehicles that we teach, share it over in the comment box. I love reading little couple sentence kind of testimonials. I love to hear what you guys are using your policies for, how you've set this up for future generations. And what we're going to talk about today, it can go a couple ways. Myself, I started with policies for myself, my wife, and then I started learning about how to create a banking system, incorporating my son into it all. Now, I know other clients that were like, hey, I already have some stuff going for myself, so let me start with my children and then go from that way. So there's no right or wrong way to do this. And the beautiful thing is our money mentors like Brian are going to talk through your entire situation. So we'll set up a strategy call with you to talk about your specific situation. And the best thing is there's no sale today. We're not here to sell you anything. We don't have anything to, say, hey, run your credit card here. Even the strategy call, 60-minute video call you're going to do with Brian or one of our money mentors, completely free of charge. All the support and handholding into the future, completely free of charge when it comes to becoming your own bank. So just wanted to kind of set that up right there. Then we're going to dive into a little bit about how to maintain wealth from one generation to the next, start avoiding those wealth killers like taxes, things of that nature, and then the power of these juvenile policies. Because if you've learned one thing, or maybe you've heard one thing so far, a lot of what we teach is built around what's called compounding interest. And really, Albert Einstein, in my opinion, said it best. See, Albert Einstein called compounding interest the eighth wonder of the world. He said those who understand it use it, those who don't pay it. And trust me, you want to be on the side of that's using compounding interest. And we give you lots of examples with this, but just remember, it's going to boil down to compound returns. And when you look at compounding returns, what's the one thing that you can really take advantage of on your side? It's time. So the longer you have, the longer that runway is, the more you're going to get out of all of this. So what's the beautiful thing about children? They're very young. They have their entire lives ahead of them. So if we can start setting this up properly for them today, I mean, the sky's the limit. And like Chris mentioned, we have examples like Vivi Lucky Jeans that show you exactly like this looks like through the life of a child. And it's truly mind-blowing and life-changing information. So really looking forward to getting all of this. So Brian, I know you're going to kick it off with a little bit of kind of a presentation just to kind of set the stage, and then we'll get into some back and forth. We're also here to answer all of your questions. So please put your questions in the Q&A box. I'm just going to warn you, the comment box over here, it gets going fast sometimes. We start answering or we start asking questions and getting conversations going back and forth. So please utilize the Q&A box and we'll answer all of those questions as we go here with you today. So again, one more time, my name's Stephen Nagy. I've been working with Chris since 2019, changing lives. We've helped, I don't know, Chris, at this point, close to probably 10,000 clients over the last 5 years, learn about the infinite banking concept, start implementing this into their lives and changing their lives financially. And I've been doing as a financial advisor and investor entrepreneur and since 2005. So with that said, Brian Fouts, what's up, man? Thanks for being here. What's going on?
Absolutely, man. Yeah, it's kind of cool. I've been seeing some of the same names I saw on the webinar yesterday, Take Back Control Tuesday. So I love seeing those familiar names, people that are always learning about this concept from us. So appreciate you all being here. But yeah, what we're going to be talking about here today really is generational wealth, because it is one of those things a lot of us don't get to experience. But there are those that can experience this, and it starts with one person. It starts with you creating that today so that the next generations can have that. So we're going to dive into that. A little bit about me. I first learned about infinite banking in 2013. I had a very inappropriate policy put in place by somebody, learned a lot about it, but then got into it. And I learned a lot about financial literacy and knowledge through Robert Kiyosaki and his personal advisors. I worked with a lot of them personally. Actually, one of them was my mentor for infinite banking for many years. And so I learned about how money really works. And that's stuff that is not taught traditionally in schools. We're not taught how money works. In fact, we're taught to help other people make a lot more money at the sacrifice of ourselves. That's my personal belief right there. But yeah, so I'm going to have some slides, and then we're going to actually look at some actual real illustrations for some juveniles, and you'll see the power of how those work over time. As Stephen said, compound interest, one of the most amazing things in the world. So, and this is interactive, so please ask questions. Use that, use the Q&A box. You have questions, or if you guys just want to comment, obviously do that. I want you to think about this question: how is wealth destroyed? Now, Stephen mentioned a few ways that it's destroyed: inflation, taxes, interest to other people, right? But how is it destroyed generationally? Okay, so I want you to think about that. How is it destroyed generationally? And if you guys have any, thoughts on that, go ahead and put those in the chat box. So let's start kind of thinking about some of the ways that it's destroyed. So obviously, one of the first ways is watered down among family members. So let's say you have a $2 million inheritance, but you have 5 kids that receive it. It's watered down among all of them. Okay. And I have personally experienced this. So one of my grandparents was fairly wealthy. And then when they passed away, then that wealth was distributed between 3 kids. It was watered down. And so my parents are doing the same thing. They're going to water it down again to me and my siblings. So it's getting watered down. It's getting diluted. So that's oftentimes how it happens. Spending, someone says spending, they're selfish parents. Kind of, yeah, but it's their money. If they're not wanting to create an inheritance, yeah. Yeah, Shane said blow through their inheritance. Yes, that's it right there. So a lack of wealth, of knowledge being passed on. That's probably, I would say, one of the biggest ones, is just not having that knowledge being passed on to that next generation of how the wealth was created in the first place. Because I always say that it's nice to pass money on. That's great. But what is more important? What is more valuable? It's the knowledge of how the wealth was created in the first place, because that'll allow that family to then retain that wealth. That makes sense? So knowledge is one of the biggest ones. Yeah, Shauna said by the 3rd generation, 90% of the wealth is gone. And so that's what the stat, if you go look up the stat, that's what they say. 3rd generation, 90% of the money's gone. I did the math on my family. That's exactly the ratio of what I will receive. It's crazy. That is exactly true. 90% is gone by the 3rd generation. So yes, exactly. So some other things that really destroy generational wealth, or wealth generationally, here is no family purpose, no mission, or higher reason. So wealth without a purpose is squandered. It's gone. It goes away. If you have a purpose, by the way, the money sometimes is the secondary thing. The purpose is actually the focus, and the money comes as a result of that. So not having a purpose, a mission, a higher reason to maintain the wealth is a big one. Okay. Yes, and someone said how the wealth was created in the first place. Yeah, that's the knowledge right there. If you don't pass that on, they're not going to maintain it, right? Conflict of differences of opinion. So that's, if you see people that fight, you can look at wealthy families or celebrities that pass on without a good strategy, and then all of a sudden you find that their estate is in the court system for years or even decades because they're fighting over it. People are fighting over it. So not being on the same page on the wealth, that can really destroy it pretty quick, by the way. I used to have this poster, and it was for estate planning. I had 3 of them on a wall, and it had all of these really famous people and how their estate was destroyed, their wealth was destroyed because they did not plan ahead of time accordingly. I think Michael Jackson may have been one of them on there. There were some other really famous people. I cannot find those posters anymore online, but they were really cool. But I'd like to find them again. Had a lot of really cool examples of why you got to take care of your wealth when you're alive, not after the fact. Yeah, someone said birthright. Yeah, can ask heirs what they would prefer. Yeah, there's some good answers right there for sure. So another one is passing on only money, not assets or strategies. So this is actually what happened with my family. So what they passed on was just money, pure cash, nothing else. There was no business, there was no assets, there was nothing actual tangible that was passed on. So if my parents, the next generation, had wanted to maintain that wealth, they would have had to put the money to work. They would have had to done something with the money, but because there were no assets that they could just inherit and then hold on to keep that cash flow coming in. So they put it in the markets is really what they did. That's all. They didn't, my grandparents, they had some buildings, some real estate, but those were all liquidated and then passed on. Then it was only money that was passed on. So when I saw that, it was kind of unfortunate for that. Okay. Now I don't know why it passed up 6, but whatever. So relying on outside advisors or advice. So this one, I've talked to some clients that have this, where they received a bunch of money, and then what do they do with it? Well, they do what everybody else around them is doing. They go talk to a financial planner or financial advisor who's going to put them in traditional things. And then guess what happens? The market, as Stephen mentioned, volatility happens, interest happens, fees happen, and all of a sudden, 10 years down the road, there's very little left because it wasn't really managed very well. Okay? So 6, a lack of estate planning or transfer strategy. This one, I'm going to say is probably one of the top 3 for me. If you do not have a strategy to pass the wealth on, it can get hung up in probate. So probate is a really bad thing for a lot of people. I've seen it with my own family. I saw one grandparents, it went through probate. They had no wealth, but it still had to go through probate. It cost money, and it took 2 years. Okay, and it's also public. So when you go through probate, it's public. It's open to the public. It's open to lawsuits. And there's a story that a client of mine told me many years ago, and this is really it really hit home for me because I had a grandmother like this. So the grandfather passed away. The grandmother was still alive, and she had a home, and they had some other like little assets and stuff. And so for some reason the grandfather's estate went into probate because the grandmother's name was not on a lot of things. So think about, like the old way of doing things where the male had a lot of the assets under their name, the female didn't. That's what happened. And then what happened is the grandmother started getting phone calls in the middle of the night, 1 a.m., 2 a.m., 5, in really early hours, and odd calls. But what was happening is that people saw the estate in the court system, and they were calling her to try to get her to sign over assets to them. It's nefarious. It's illegal, I believe, but that's what was happening. Unfortunately, the grandmother, she actually was talking to them about the assets. She thought they were legit people, and somehow one of the kids got wind of this and stepped in, and they avoided it from happening. But there's horror stories out there of this kind of stuff happening. So probate, it's public. That's also where you'll see a lot of wealthy families, celebrities, things like that, where their estate goes public. All of a sudden there's lawsuits. Hey, I'm a long lost kid. Hey, he said I could have this. All of a sudden the courts get involved, lawyers get involved, a lot of fees, a lot of money, and wealth is destroyed. So how do you avoid that? Well, one of the ways is through trusts. So a trust, and people say that that's asset protection. I don't really say that it's asset protection. It's more asset privacy. So it privatizes your assets. But what a trust does is it privatizes your estate, and then it puts your wishes inside of there, and then you have an executor, trustee, someone who then puts that into action upon your passing. But trusts are a great way for generational wealth to be maintained and keep it inside the family. Additionally, wealthy families, and I was taught this by Robert Kiyosaki's asset protection attorney. His name's Kevin Day. So he taught me this. And the way they do it is they have a third party that steps in and takes over the estate or the trust. They operate the trust. So the family actually has to abide by a third party. They have to trust them, of course, all that kind of stuff. But that's how some of the families do it. So that's one of the things that we definitely recommend is a trust. We have people that do it for a lot of our clients. So these are some of the other ones. So I know there's a lot of other things that came in here, a lot of great comments on how wealth is destroyed, but understanding these things and avoiding it is one of the first things you got to understand if you want to create generational wealth. That makes sense? Yep. Yeah. Okay. So now let's kind of quickly talk about how generational wealth is created. So if you want to have generational wealth, you've got to create it, right? So the first thing, you can create it during your lifetime. So how do you create wealth during your lifetime that you can then pass on? Well, I mean, you can be a high income earner, trade time for money. I have a doctor client who's making $500 some thousand per year, has a lot of disposable income. So he's making that money now. A business or entrepreneurship. So a lot of us here on the call, Stephen, Chris, and I, entrepreneurs, we own businesses. That's one thing that you can potentially pass on, right? Assets, those kind of things. So investing in like real estate over time and passing that asset on to the next generation is one way to do it. Getting lucky. There's always the getting lucky part of it. You get a big windfall of capital. You hold on to that. But really, one of the ways we're going to be talking about here in just a moment is how to create a vehicle that creates wealth for the next generation, guaranteed. Because all the first things up there, right, they're not guaranteed. Your income passing on is not guaranteed. Your business is not guaranteed that it'll survive into the next generation. Investments go up or down. There's risk involved in all these things. You probably won't get lucky either, right? So there's risk involved in a lot of these things. So there's no guarantee they're going to be passed on generationally. But infinite banking, what we're going to be showing here, it's actually a way to guarantee generational wealth and tax-free, okay? So, but the bottom line is that it has to start somewhere. This is the thing that you have to understand. It has to start somewhere. Go look at any wealthy family that is wealthy generationally. It started with one person doing something different. Carnegie, all these people, the Rockefellers, they did something different. So it starts with you. If you're currently not wealthy generationally, maybe it's you that's going to start that process. Maybe it's you that's going to take on the responsibility, the reins of doing that. So, but that's the thing, is it starts generationally. You can't blame the past generation, right? It starts with you. Okay, so now we're going to dive into juvenile policies, because they are one of the best ways to do what we're talking about here. And obviously Chris has policies, I have policies, Stephen has policies, so we can go through how these things work. Now, this is where I want you guys to ask questions as well about these. Just look at some of the quick comments here. Yeah, so Tony said that's my parents did it with a trust. My brothers and I are trustees. Exactly. Trust is recommended for anyone regardless of financial status. Larry, it's a good question, by the way, and this is not financial advice or all that kind of stuff, but for me, yes, because you have assets, you have stuff you want to pass on. I recommend a trust. My family that did have money, they did have a trust, and so when they passed away and everything happened, it was like that. It was fast, and it was all laid out. Everybody knew what it was, and it was taken care of. So absolutely. Yes. And Tess, great point. People that, when I mentioned the thing getting lucky, most people that receive big windfalls, lotteries, within about 5 years, they're back to where they were or in a worse financial situation. I think it's 60 to 70% lose it. Okay. So having a trust is a great way to make sure that does not happen to the next generation. That's also why passing on knowledge is so important as well. They're who they were before and after. Yeah. So that's one thing you got to consider. If you want to create generational wealth, you want to create wealth today, you've got to also maintain it or keep it. That's the one thing we always say, is that, people work so hard to make their money, but they work very little to actually keep it or protect it. That's a thing that people miss. And so for me, I've lost over $500,000 through investments or strategies that I didn't really understand or control, because I didn't have the knowledge. First off, I didn't have the knowledge, but one, I didn't do the first step, which was first paying myself and then controlling that money moving forward. And so my first policy, infinite banking, by the way, was not set up correctly, ended up costing me, if I do the math, I don't really like doing the math, probably $150,000 to $250,000 of lost wealth, because I didn't do it correctly and I didn't understand what I was doing. So yeah, very important there. This one, okay, yeah. So this is that slide right there you're talking about. Yeah, so yeah, these are how wealth is destroyed. So if you guys want to take a quick snapshot of that one, how it's lost. And by the way, there's lots of other ways that wealth can be destroyed generationally. Just keep that in mind. These are just some of the more common ones. And I've actually been very fortunate to be in the same rooms with some billionaires. I know Chris has, we all have, but I've talked to them and I've actually interviewed them. And they talk about how they've actually, every single one of them has lost a significant amount of money first, and then they build the wealth on the second or third time because of the lessons they learned. And there were some crazy stories about things that they did, losing, $10 million and being bankrupt and then going back and becoming a billionaire. It's nuts. But a lot of these things are what they have learned in their own lives, and they put in place. And in fact, I was doing the trust stuff one time, and there was a person that came up to me and actually did state that, yeah, what you're talking about is what we are currently doing, that they're working on. And I've had clients that have done the same thing. So yeah, Chris says, yeah, most of them are never taught. Yeah, exactly. Yeah, athletes are the same thing. Good point there. Athletes are not taught about money. And so I was talking to a gentleman. He's an athlete. He's a football player. Gosh, I can't remember who he played for and what his name was, top of my head. But he had a business that actually helped athletes maintain their money and control the money after they're out of the sports, because they're only making that money for 10, 15 years, but they still got a huge life ahead of them. That money's got to last them that time, right? And they need a lot of help. As Shauna just said, they need a lot of help. So that's what he did. He had a business that would do that for them. It would educate them during their working years and then help them after the fact. So yep. And Larry, they're definitely going to get into what's the right way to structure a policy especially for juveniles. So let's kind of dive into the juvenile side of it, and then keep the comments coming. Okay, there we go. All right. So when can you start a juvenile policy? Well, the bottom line is when they're born. I think it's about 1 week usually is when you can, as long as they're born healthy and there's no complications out of the hospital. You can start a policy right off the bat. So keep that in mind. So people think that, they got to be 1 year old, 5 year olds. No, they don't. It's basically 1 week in most cases. Okay, pretty fast. Now let's kind of talk about the coverage amounts. So when you have infinite banking policies, it is a life insurance policy, but keep in mind, it's just the engine. But with juveniles, we've got to understand how the engine is built, because there are certain limitations, I guess I would say. So one of those limitations is the death benefit. So the death benefits with infinite banking, these specially designed policies, it goes up over time. Yeah, Dex, after getting their social security number, that's right. That's a good point to make, which typically is pretty fast. I can't remember when I got my kids' ones, it was pretty fast. But the death benefit, which is a part of infinite banking, there's a limitation on juvenile policies. Okay. Now keep in mind, it's always increasing. So you're going to see a policy here in a moment where it starts out at a very small number, but the number is in the millions of dollars down the road. Okay. But when we start with the policy, the amount that we can get covered on is going to be dictated based upon the guardian of the child or the parent, whomever's the guardian. Okay. So the rule is this. So one is most insurance companies, they want to see the guardian or the parent covered first. Now, from an insurance perspective, that makes a lot of sense because the guardian is the income earner. So when an income earner passes or, passes on or graduates prematurely, as we call it, there's a financial loss in the household. So there needs to be coverage so that other people, the kids, have some money to survive, to live, etc. Weird to say this, but if a juvenile passes on, unfortunately, prematurely graduates early, is there a financial loss in the household? In most cases, no, there's not. So that's why they look at the guardian first, and then you can insure the kids. And some companies look at both of the parents or guardians, so mother, father. Some look at just one. It depends on different companies and how they're looking at it. Okay. The other option is when you can insure a child is if the guardian or guardians or parents are uninsurable. So if you can't get a policy, you're denied, then they will typically allow you to get a policy on your kids or a juvenile. Okay. And I've had this happen many times where it's actually, I have a client right now that's doing this. They got denied because of certain things in their background. And so they're getting policies on their, I think it's 2 kids, daughter, son. So, and they're allowed to do that because they can't get a policy on themselves. Okay. So that's something we're doing right now. So the other thing to keep in mind is the coverages. So you can't just go get any kind of a coverage, death benefit you want on a juvenile. There's limitations. And yes, Wendy, I'm going to cover that here in the next bullet point, guardian policies or grandparent policies. So let's say that you as a parent, you have, let's just say $500,000 of death benefit. So what can your kid get? Okay. Your kid can get anywhere from 50% to 100% of that same death benefit on their policy. So sometimes when we're building juvenile policies, we back into the numbers because we have some limitations we got to work with. Every insurance company has different underwriting guidelines. And so we just got to work within those guidelines based upon what you're trying to do. If parents are divorced, by the way, so mom can't get covered, can the grandparents get directly on the grandkids? Yes, James, that's a great question. I'll answer that one here in just a moment, a little bit more detail. That's a good question right there. So every company's a bit different. The other thing that's very interesting when you do juvenile policies as well is let's say that you have 3 kids and they're all, and by the way, juvenile is under the age of 18. So age 0 to 17, by the way. So just FYI. All right. So when you have 3 kids and they're all different ages, they do not let you, in most cases, insure just 1 or just 2. You have to insure all 3 kids at the same time and for approximately the same values in the policy. So every company is a bit different once again, but they look at either the death benefit being close to the same or the premiums being close to the same because age makes a difference. If you have a kid at 1-year-old versus 15-year-old, the death benefits are going to be very different. So they might make you make the death benefits close to the same, or they might make you the premiums close to the same. Okay. So it just depends on the company and their guidelines. So we work with you on that and what you're trying to accomplish. But I've done, 5 kids at one time before. And so, yeah, so there's lots of different ways to do that. Shane, yeah. So yeah, 50 to 100% of what you're currently insured for is what you can insure the kids for. Exactly. Different companies. Yep. Okay. So let's kind of talk about grandparent policies. So keep in mind, we're talking generational wealth. So I have a lot of grandparents that say, hey, I want to create generational wealth, but I'm of an age where I can't get a policy or I'm uninsurable because of, health and medical reasons. So there's one company has what's called grandparent policies. And that company, you can get a policy for a grandchild up to $100,000 death benefit without the parents having coverage or the guardians having coverage. So that gives you options. So I'm doing that with some clients right now called the guardian policy. Lucy, if she's on, she's one of them right now doing that. Or actually, no, she's already done doing it. But yeah, so you can do them on grandparent or grandchildren to create generational wealth. A lot of times also what you can do if you want to create generational wealth, but it can't start with you because of financial, medical denials, whatever, is you can open up policies on your adult kids, teach them how this thing works so they can then do policies on their kids. And now you're starting to do multi-layered generational wealth. Yep. So keep that in mind. So there's lots of ways you can use infinite banking to start that ball rolling with generational wealth. Because remember I said, who does it start with? It starts with you. But it does not have to be actually you being insured, by the way. It can actually be somebody else. It can be a grandchild, it can be an adult kid, etc. James, but all grandkids covered at the same time. Yes, yes. When they do the grandparent policies, they call them, or grandparent policies. Yeah, they would want you to insure the kids at the same time if they're all under the age of 18. Yep, yep. Yeah, Shane, that's what I call the waterfall method. Is you start at the top, the patriarch, and you work your way down. So grandparent, adult kids, grandkids. And so I've done that all at the same time, by the way. I've done policies on all 3 levels. It was 8 policies at one time. It was a lot of fun doing that. But the grandparent, the grandfather, wanted to do all this thing at the same time and get everybody learning how the things worked. So that's what he did. Yeah. So it was really cool to do that. But yeah, you can do that. Yeah, exactly, Sean. That's cool. George says, I have no children. Can I insure a 48-year-old niece? Yes, you can actually. So if you have no kids and you want to do it on your niece, you can do that. We would do what's called a cover letter. We'd explain why you're doing that on your niece. And it can be okay because I have wealth, I have money, I want to pass it on to the next generation. I want to do it via a secure strategy through life insurance. So something like that. That's you got to explain the why you're doing it. The insurance company wants to know. Because keep in mind, the insurance company, they're human beings, right? They're humans, right? All they want to understand what you're trying to do, and if it makes sense, and yeah, pretty easy. And Wendy says, I've got 12 grandkids. Now, it doesn't have to be on all, if they're with different people, like different parents, it's not all the grandkids, it's whomever's underneath that guardian. So if you have 12 grandkids, but let's say 3 of them are with your daughter, then it'd be those 3 at the same time. And there is some wiggle room, by the way. There is some wiggle room in that, in some of the underwriting guidelines. Keep that in mind. But yeah, 12. There you go. That's a lot. So yeah, so the last thing it says, you must treat, kids equally. Okay. That does make sense. If you have, 3 kids under 18 and you're getting one policy for a large amount on one, that's kind of a weird thing. They're going to kind of raise their eyebrows at that and ask you why you're doing that. It says 12 grandkids and need a lawyer to manage the trust. So do you have a trust already, Wendy? But yeah, I mean, if you have a trust already, it should be set up by an attorney, by the way. So that should be the person that helps you structure it correctly and then understand how to use it. But yeah, I mean, the trust has to be set up correctly. Yeah. 8 kids, 12 grandkids. Ooh. Yes, yeah. So if you have that much family, down the line, definitely your trust has to be structured to, support that. That's pretty cool. Do you have a list of lawyers that understand these concepts? Has Elena? No, we don't have one. We just have our preferred people that we work with, and we can refer you over to them if you'd like. Just reach out to us personally and reach out to Shauna, and we can connect you with them. But that's a great question, though. So if you're ever going to go do a trust and you have infinite banking, you've got to. I recommend finding an attorney who understands infinite banking, because they may not, or at least insurance in general. At least insurance in general. Okay. So Shane, if one of the 3 is not insurable, then the insurance company would cover the other 2. Correct. Yep. I have that happening right now, where one of the kids is not insurable, the other one is. And so that you can insure just the one. That's no problem there. 3 kids, 18, but no grandkids yet. If I set up now, any grandchildren can be covered after. Yeah, absolutely. Yeah. And yes, and you can get this for your mom. You can get infinite banking for your mom. Okay. And then Shane says, one of mine has type 1 diabetes, so insulin dependent. Yeah, insulin. Yeah, that's the big kind of catch with insulin or diabetes. If you have insulin, it typically you cannot get a policy. Yeah. And then Herminio, does this apply to stepchildren and their kids as well, married into a blended family? It depends on who the guardians are. Great question, though. It depends on who the legal guardians are. So if you have stepchildren and you have adopted them and you're the legal guardian, then it's gonna be you. Yeah. Yep. So, okay, great questions. All right. See, yes. Okay. You don't have a trust yet. Yeah. Make sure you get with somebody who understands insurance and then understands generational wealth through insurance. My recommendation for getting that trust set up. And then should I restructure existing or trust or start a new one? That would be a question for the attorney. So if you want, reach out to Shauna and we can refer you over to somebody. They can answer that question for you. Yep. All right. So juvenile infinite banking policy. So this is, and we're going to look at some illustrations that are pretty cool. But here's the power of these things. This is what's so amazing. When you have a policy, you're going to fund it. That's called capitalizing the account, capitalizing the policy with premium deposits. Okay. So as you do that over time, those premiums are going to build up along with the cash value. A lot of you know how this works. But here's the thing. When you do infinite banking on a juvenile, you're going to 10 to 15x the money that you put into the policy for the next generation, tax-free guaranteed. So I want to repeat what I just said. Okay. So when you put money into this policy, it's going to 10 to 15 times its value for the next generation, tax-free and guaranteed. Okay. That is amazing. But what's even more amazing is during the lifetime of that person, you're using the money to create additional wealth through assets or asset cash flow while still doing the generational wealth with the death benefit. You're doing both at the same time. And so this really hit home for me. This was like about, oh my gosh, like 6 years ago. Yeah, hey, Lucy, yeah, see you on there. Yeah, so she saw me do this presentation before, and then we did a policy for her grandkids, and the parents of the grandkids are not covered. So there you go, right there. So this hit home for me. I was doing an infinite banking presentation in front of this really high-end mastermind group about 6 years ago. And I was talking about infinite banking. I was talking about how they use it for generational wealth. They get it on all of their kids when they're born to do this. And in the room was a person. And this person was and you guys may have heard me talk about this person. He was the original shark on the show Shark Tank. He was the first shark. His name's Kevin. And his business partner, Mark, was there as well. And they came up to me afterwards and they said, hey, Brian, you're right. We do this on all of our kids. And one of them, Mark, which is Kevin's partner, walked me through how he was using his kids' policies during their early years to create assets to multiply the generational wealth. And he was buying warehouses and then leasing them out. It was a cool story, but it was kind of cool to have a truly, wealthy person, billionaire person come up and say, yes, what you are assuming we're doing is exactly what we are doing. So anybody can do this though. That is what is amazing. Anybody can do this. Okay. So 10 to 15 times the money using the banking policy, but also using it as your bank while you're living. Yes. And Rob, yeah. Some companies are more lenient than others for sure. Like Steven just said. I'm quadriplegic. Can I qualify? So Crystal, we'd have to ask. In most cases, it depends on the situation, on why, and if there's any limitations, any kind of medical issues. We'd have to ask them. So that's called preliminary underwriting review, by the way.
Yeah. Hey, Brian, real fast, just on that, if there are any specific, health challenges or you're not sure if you qualify or not, just schedule a call with our team and we'll get the information we need to be able to submit that. We don't have to do a full formal underwriting application. We can, like Brian said, do a preliminary check and at least know if, it's worth going into the full underwriting. So just schedule a call with our team. We'll talk to you about the whole situation and see what we can do for you. Thanks, Brian.
Yeah. Absolutely. And then someone said, how do kids qualify? So kids, they qualify just by the nature of living. They don't have to go through the medical or the financial. The financial, by the way, good question. To qualify for a policy on a juvenile. Okay, so they don't have to go through any medical exams unless you're asking for a very large amount on the kids. If they're in their teenage years, they may require a medical. We've had it happen on like some teenagers before because the amount being asked for is extremely large, very large. But in most cases, you as the guardian or the parent or whomever is going to have to sign off on the application, which you're going to disclose the medical. So if there's no medical issues, there you go. If they're like maybe autistic, as an example, you're going to have to disclose that. Like my son's autistic, but he's level 3 high functioning. And he's 12, so he can get a policy. I think it's age 4 or 3. If they're autistic, they have to reach that age before they can get a policy. But yeah, generally speaking, kids get approved extremely fast. Okay. Now, if you're over the age of 18, then of course, the underwriting comes into play a bit more and you have to qualify on your own merits. So financial and health are the two main things. So if you're over 30 or 30 years old, you're going to have to qualify on those two. But keep in mind, the underwriting is not the same for every person. It's going to depend upon how much you're asking for, your gender, your history, your medical records, your financials, all these things. And we go through that with you on the phone call. Okay. So yeah. I want to insure any of them. Yeah, there you go. Yeah. So yeah, Edward, you have 17 and 11-year-old. How much would I need, or do you recommend the specific amounts to start the policy? Great. So let's grab these kind of questions because these are the good ones. So with a juvenile, you can do $100 per month. Okay. I've tried to do them at $50 per month, and I really haven't been able to make a policy work at $50 per month with one of the insurance companies. I didn't try all of them, but typically $100 is what I recommend minimum on a juvenile policy per month, or $1,200 per year. Okay. So pretty simple. And then, so if you have an 11 and a 17-year-old, $100 per each, or if you want to have a certain amount of death benefit, then it would be, whatever that number is. Okay. So we just work with you on that, Edward. And then Rob, it depends on why you're declined. So that it depends on that one.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Okay, so what I'm going to do now, I'm going to bring up and I'm going to show you a couple illustrations on some juveniles, and I want to walk through the numbers here because there's a lot of numbers, but I want to point out some very specific numbers here. Okay, so this is for firstborn. I put it as actually they were born April 1st, April Fools. So they're born April 1st, 2025. So they're about 4 weeks old at this point in time. So what you'll see here on this is it's called a preliminary illustration. So what you're going to see here is a few things. So one, I put in $250,000 or $250 per month going into this policy. So once again, it could be 100, it could be 250, whatever. Okay, no dumping. So to answer your question, Shane, I'm not doing a dumping on this one. I'm going to show you another one where we are doing a dumping. Okay, and then someone can answer Rob's question there, but yeah. Okay, now this one is what's called this is with One America Financial. Okay, whole life 121, and I'll show you what that means. Juveniles, when they're approved, they only can get a standard rating. So when you're over 18 or older, you can get different ratings on yourself. So you can get substandard, which is not good. You can get standard, which is the normal one that most people get. About 90% get that. And then you can get preferred or super preferred, 2 levels above that. But juveniles get standard in most cases. Okay, age 0. So you'll see right here the initial death benefit. So this $250 per month is getting this person an initial death benefit of $147,000. Now that's going to depend on what company you're going with. One America, by the way, has slightly higher death benefits just by the nature of how they do business, which can allow you to do a lot more versatile things with juvenile policies, why I like One America for juvenile policies. So there you go. So now what I'm going to show you is the numbers year over year and how this thing works. So this is all kind of the boilerplate stuff. We're not going to go through that on this call. We can do that on like a one-on-one call, go through all these pages if you want. Most people don't, but there you go. All right, so this is what's called the tabular detail. And you're going to have 2 sides to this. You're going to have what's called the guaranteed side, which every company has a guaranteed number in most cases. And then you have a non-guaranteed number, right? So which side do you think we look at? Well, everybody says the guaranteed side, right? Because that sounds great, guaranteed. I love guaranteed. But in reality, with mutual insurance companies, the ones that do infinite banking the best, by the way, the non-guaranteed is what includes the dividends, okay? And dividends, by the way, have been paid by these companies pretty much every year they've ever existed. They've never not been profitable is why. So if you think about what I just said, where do you want your money? Well, that kind of makes sense because they've been profitable during the Great Depression, World War I, World War II, COVID, the last recession. They've always made money. They've always paid dividends. So we focus on the dividend side or the non-guaranteed side. That make sense? Okay. All right. So what you're going to see here is the contract premium side. So this is the amount going in per year. These are all end of year numbers. And so this one is $3,000. Why it's a little bit less is because they back out the ACH monthly transaction fee out of the premium on this illustration. Okay, so what numbers do we look at? So there's the death benefit, and then there's the total cash value. So I really only want to focus on these 3 columns. The rest of them we can explain on a call if you want, but those are the 3 columns that we want to focus on. So once again, premium column, total net cash value column, and the total death benefit, right? Now, what you'll notice is in the first year, this child has a little over $2,000 of cash value and $170,000 of death benefit. But wait a second, the initial death benefit is $147,000. So what's really cool about this is the death benefit grew from 147 to 169 in that 1 year. And as you can see, every year is going up along with the cash value. Okay. So when this person is, let's say 10 years old, they put in $30,000. They have $29,000 of cash value in the policy. And the death benefit is what, 30 some times that number that they put into the policy. So think of what I just said. So right now, this person is insured. If something happens, now we don't want that to happen, but if something does, the money they put in there is going to be worth 30 times more to the beneficiary or the next generation. Okay. But they've also got $30,000 that they can use during those first 10 years, or whomever's managing the policy can use. Now let's fast forward even more. Let's go to 30 years down the road. So that's what, $60,000 has gone in? No, not 90. 90,000 has gone in. So yeah, so 30 years down the road, $90,000 has gone in. Now what do the numbers look like? Well, the cash value is $149,000. So it's more than you put into it by almost 100%. And the death benefit is $788,000. Okay, that's pretty powerful. Now, what you'll see here is I dropped the premium down a little bit just because the policy is very efficient. Maybe we go and start 2 or 3 more policies, but here's where the generational aspect really comes into play with these. So imagine that you set this up on your kids, your grandkids, okay? Thinking about the next generation, what happens for that next generation now? Let's go to age 65. So here we are, age 65. How much have we put into this policy? Well, I did the math before the call because I can't do the math on the fly. It's around $116,000 has gone into the policy by age 65. What's the cash value? It's $700,000. That's like 6 times what you put into it. So what can you have done with that money in the previous years to build more wealth, to buy houses, buy investments, buy cars, whatever during those years? But here's the powerful thing. You put $116,000 in and the death benefit is almost $1.3 million. That's tax-free guaranteed right there. Very, very powerful. That's amazing right there. That's amazing. So once again, tax-free guaranteed. And by the way, this entire thing is private. So wealthy people that do this, you don't know what they're doing behind the scenes if they're doing infinite banking because it is private. So keep that in mind as well. So now moving forward, let's say this person reaches the age of 80 years old or 90 years old, okay? And you put in, now it's about $130,000 you put into this policy. The death benefit is almost $2 million. And you think that this family is only doing one policy? Absolutely not. Yes, Francis, because you're funding the policy, the death benefit is always increasing along with the cash value. Same with adults too, by the way. Same with adults. No, the death benefit on an adult policy goes up as well. Infinite banking policies, mind you, I'm talking about not other things, not VULs, which go down, by the way, but infinite banking whole life policy, specially designed for infinite banking, the death benefit is increasing. It's increasing. Now, because of the age and the compounding, they have a long time. Yeah, they have a long time. Okay. So now what I want to do is one last thing. I want to show you the same illustration, but we're going to do what we call a dump in. So with infinite banking policies, we can do what's called a dump in. That's where you put a larger amount in at the very beginning of the policy. And so on some companies, you can do this, some you cannot. So with One America, you can. So let's come up here. Same thing again. I'll zoom in. Okay. So same thing. We're putting in $250 per month, but we're doing a $5,000 lump sum dump in, as we call it, specially designed. That's right. That Shane said that right there at the very beginning. So what does a $5,000 dump in at the beginning of this have an impact in over the years? So one, you'll see this. The death benefit is $394,000 day one. It jumped up by over twice as much. So keep that in mind. Now let's go down here and look at the numbers. Okay. So you'll see the death benefit is very high early on because of this. That's because of One America. Additionally, we put in, $8,000 here. The cash value is $6,000. Now we go down to, let's say, year 10. We have put in $35,000, cash value is 31, death benefit is 552. Now that doesn't seem as efficient as the first policy, but keep it in mind with this one, it's time. They have a long time to do this. We're not worried about typically the first, few years. Yes, we can use it, but we know the thing is going to grow more and more over the years. So now let's go 30 years down the road. Okay. 95,000 has gone in, $154,000 cash value and $888,000 of cash value. That is significantly different than this one at 30 years because we had put in 90,000. It's 150 versus 154. So the $5,000 got us, about $5,000 more there, but the death benefit is $100,000 more. Now, one last thing. Let's move all the way down to 65. So now how much has gone in? A bit more has gone in, so like 120,000. But the cash value has jumped up to $813,000 versus this one, it is $700,000. So $5,000 dump and upfront got us $113,000 more of cash value over the years. Okay. But what's even more different is this one. We had 1.3 million on the first policy, but the dump in, now the death benefit is $1.5 million, which means it got us approximately a little over $200,000 more of death benefit. Okay. And keep in mind, if you borrow from this policy and use the cash value via the loan provision, None of the numbers on the page change. Important to note that, okay? And James, what affects how much can one dump into the policy? It's the age of the child and the premium. The premium dictates the dumping. So higher premium, higher dumping, lower premium, lower dumping. Now, on this last one thing, let's go to age 90. Okay, so a bit more has gone into this one. So it's going to be about like 100 and not 120,000. It's going to be like 160,000 in this one. But look at that. The death benefit is almost 2.4 million. That $5,000 got an additional $400,000 of generational wealth for this family. So yes, the dump-ins are extremely powerful, even with juveniles. So guys, that's all I got for you. I know we're kind of at the top of the hour right here, but I hope this really shows you the power of what this can do generationally. But also keep in mind that this is not just for next generation. It's also for when you're living, the living benefits, right? When you are living, this person can use the cash value to create other wealth, do other things with it, to fund businesses, fund investments, fund their lifestyle, whatever they want, right? There's so much things you can do with this. It's the limit is your imagination. It's your imagination. You have to keep that in mind. All right. How can a loan not change the numbers going forward? So Sandra, with infinite banking, specially designed policies like this, we use what are called non-direct recognition companies. The loans are outside of the policy essentially. So the cash value is the collateral, but it does not change the dividends you earn. So that's just how it works. Yeah, that's how it works. What carrier is this issued by? So this one right on the screen right now is One America Financial. One America Financial. They got really good juvenile policies. Why I kind of like them. Other companies can do juvenile policies. I just really like how powerful One America's ones are. They're really cool. So CG said, so if they live in Connecticut, wouldn't be able to take advantage of the carriers where there if they are in any different carriers than New York. I'm not sure what that means, but yeah, I mean, we can do these and we can do infinite banking in New York. So I got a lot of clients in New York. It doesn't matter where you're located. If the grandkids or juveniles are in another state, that doesn't matter. You can still do policies. Yeah, Crystal. Yeah, schedule a call. Absolutely. Yeah, and you can, as I said, you can do $100 per month. Now the dumping can't be $5,000 with $100 per month, but you can still do policies. In fact, I've got dozens and dozens and dozens of policies out there that I've written that are $100 per month or $150. I just use $250 because was one of my clients did that. Yeah. So guys, any other last minute questions? Yeah, and there's the link for the mentor link. So if you guys want to talk to any of our mentors, and I'll put in, if you guys want to reach out to me personally, I'll put in my personal email as well. So that's my personal email if you guys want to reach out. And then Jason, so if both guardians have policies, do they take that total coverage into effect? They don't add the covers together. Yeah, they don't. So they don't add the guardian together. They typically look at, depends on the company. They'll look at either the smaller amount or the higher amount policy. So if they're the same, that's perfect. If they're different, then they look at different ones. Yeah. But yeah, once again, I mean, every carrier is different. So we go with a carrier based upon what you're trying to solve, what we're trying to accomplish. That's why we here are versatile. We're not stuck with one company to go write policies. We can choose a company that's the best fit for your needs. So that's called captive. So you can be captive to one company, but we're not. So, and we have about 3 to 4 to 5 that we can work with. Do both guardians have to be covered before the kids? No, they do not. Once again, depending on the company you're going with, I've done many, many policies where only one is covered. But the reason why, we got to consider this, why is that? Well, if both guardians provide income into the household, it would make sense to make sure that they are both covered because that would be a financial loss. If one parent or guardian is not working, then their coverage isn't as important. I'm not trying to demean anybody by saying that, but they're not as important as the income earner being covered. So I've actually gotten around that, by the way, where they say, oh, we got to insure both parents. This was not working. Oh, okay. Then they allowed us to do the kids. So yeah, that's a good question though. Good question. What's your understanding of the 4 major mutual insurance companies versus other insurance companies? That's a kind of a random question. I'm not sure what the answer would want to be for that one, but we understand them fairly well. Chris and our executive team have talked to a lot of the insurance companies out there, and we work with the ones that we feel are the best for our clients to do infinite banking.
Can I just add on that real quick? One of the other things too, the carriers that we work with, not only are they the top 5 mutually owned insurance carriers, but they're all companies that support the infinite banking concepts. We've made sure that they've never missed a dividend payment, that they have a clean record all the way back, that they're true to what they're saying. So when we look at the other companies, New York Life, Barbara, would be a really good company to use. I started my career at New York Life. The problem with New York Life is they're a captive company, meaning you have to be an employee, sort of an employee of New York Life in order to write their product. So when you see a New York Life agent, that means they're a captive agent. So we are not captive, we are brokers. New York Life wants their agents to write New York Life, New York Life, and New York Life. So that means you're a one-trick pony. So that doesn't work for us. We do write with Guardian. Shauna just kind of gave you the rest of them. But the other one that you had mentioned, Northwestern, is definitely a great life insurance company, a great mutual, but they 100% do not support IBC. You can call the company, ask for a senior representative. They don't support IBC. Otherwise, we would write with Northwestern. But again, like New York Life, Northwestern is also a captive company. So you're naming good ones. Guardian, we do write with, but you're naming good companies. The issues that I outlined are the reasons why we don't use them.
Yeah, I mean, just to kind of clarify on that, guys, like one of the reasons we do the strategy call with you is, not only to understand, why you want to start the banking system so we can solve your problem, because ultimately that's what we're doing on that call. Going to ask questions. We're going to have a conversation with you to learn how to solve your problem. Whether that's paying off debt, whether that's creating a legacy using children, whether that's recapturing all the interest you would lose for financing vehicles and businesses and things of that nature, whether it's investing where now your same dollar is earning 2, 3, 4, 5 times instead of just once through the investment. There's a lot of different ways to use this banking system. One of the reasons it's called the infinite banking concept. But on that initial strategy video call that we do with you, we're also digging into who you are. What does your health look like? What do your finances look like? Because that's giving us knowledge that we're going to need to use because, like Chris mentioned, we're not a captive agency. So we can work with all of these different insurance carriers so we can understand your health situation, your family situation, your financial situation, what you're trying to accomplish. And then we can pick the best company that's going to fit your needs in the best situation possible. And everybody's different. Every single one of these policies is completely different, just like a snowflake. And that's exactly how this works. So on that call, we're really learning about you for multiple different reasons. And that allows us to then create the best possible policy for you to accomplish whatever it is you might want to accomplish. And, what happens quite often is, we might start, your first policy with you today, and then, maybe next year, 3 years, 5 years down the road, you're ready to start a second policy. And in that situation, now we go with a different insurance company for whatever reason. It could be multiple different reasons. Sometimes people want to use different insurance companies for whatever reason. So there's lots of different options there, but that's all part of what we do all day, every day, our money mentors. And that's why we do that a little bit, if that makes sense.
Let me hit on one other thing for Tim and Lucy. I can hit these both. Tim, sounds like you have a New York Life policy. I still have 2 of my original New York Life policies that I started a while ago. Matter of fact, Tim, I've done YouTube videos showing you the performance of those old 100% off-the-shelf whole life policies, and it's pretty phenomenal. So my suggestion was, although you could, it's not so much a rollover, Tim, it would more be a 1035 exchange. You could do that, but please get on a call with us. Let us review what you have. If you have a New York Life whole life, even if it's a standard off-the-shelf whole life, as long as it's got some years under it, do not let anyone ever replace that, because over time, even that normal whole life will be a really good asset for you. And to what Lucy's saying, she had New York Life, she had a 403B. I wrote plenty of 403Bs to teachers and other nonprofits when I was at that company. And yes, they make it near impossible to roll over their stuff into the other. They will drag their feet, dig their heels in. From that standpoint, it's a crappy thing to try to do, but just keep pushing it, Lucy. They will eventually have to let the assets roll over. They cannot stop that. If you've signed the documents, just don't let up on them.
There was a question from Deborah, like saying if I started with $100 a month and then eventually wanted to dump in 5,000, did you hit on that?
No, I didn't see that one. So
Okay.
so let me answer that question. So when it comes to the policy designs and doing dump-ins, the dump-ins, we are limited on how those can come into the policy. So usually they have to come in within the first 12 months for the initial dump-in. Most companies allow us to do that, but it has to come in at one time, cannot be spread out over months, but it has to come in at one time in the first 12 months. And then it's come up on a lot of calls recently where someone says, well, can I do a dump in year 5? Well, most companies will not allow you to do that. You cannot build it for down the road, that far down the road, because there's just things that change over time with the calculations and the limits. So dump-ins are usually done within the first 12 months. That's the simplest answer right there. So to take that one step further, let's say you expect some money to come in down the road, but you don't know how much. That's why we do second policies. So you do a policy today, it's just a premium, like the one I showed you, $250 per month. And then 5 years down the road, then you do a second dump in or a second policy to do the dump in. Maybe it's a different, smaller premium, something like that. But yeah, that's how we typically structure those. Now, there are some other companies where you can do more than one dump in. It's called just additional PUAs is what it's called. But you can do them years 2, 3, 4, 5, etc. for as long as you want. So there are different ways to build these things. They're not just off the shelf policies that anybody can build. Every company is slightly different. Every company has slightly different underwriting and different ways you can build policy. So that's why on the strategy calls, we're talking about what you're trying to accomplish, what we're trying to do with the policy so that we can make sure it's a fit for the right company. Yeah. And go ahead.
So just a couple people asking, why you would open up numerous policies, in your name or in a trust and what that looks like. So if you want to hit that, go ahead.
Yeah. So the multiple ones. So the juvenile ones I gave you. And by the way, this is kind of cool. So I was talking to a new client, 19 years old. He wished he'd done this when he was 1 year old. He wished his dad had done it, right? But so why you might do one policy? Well, the one at 250, that's it. You cannot put more into the policy than $250 per month on the juvenile. But let's say that child, when they are going through their educational years, their parents are doing a good job and teaching them how infinite banking works. So when that child becomes an adult, gets their first job, and that financial person at the company they're working with says, hey, here's the paper to fill out for your 401k. What might they say? No, thank you. They might say, no, thank you. I don't want a 401k because I know something better. And they'll do a second policy now because now they have income. They can do their own policy in addition to the current one. So that's why you might do a second policy. Other reasons you might do second policy is because your income goes up. Okay. As you go through your life, income goes up, but you can't put more through a policy, but you want to, second policy. If you're investing, your investments start to perform. Where do you put the cash flow? Maybe through a policy, but your previous 3 are maxed out, do a second policy. So there's lots of reasons why you might do the second ones, but that's some of the main ones right there. The other question about trust, why would you want to put a policy in a trust? So one is that, let's say you want to create that generational wealth and you do not want the death benefit to go to the family and be dispersed. You want it to go into the trust, have the trust control that benefit, and then use it per your wishes. So that's a way to make sure that your wishes beyond your life are met or put down in somewhere. Why you have the trust own the policy, if you're funding the trust and it's being funded a certain way, you could have the trust own it to fund it. That's one way to do it. Some ways it's just nice to have all your assets inside the trust, policy being one of them, so they're all in one location. And it's all personal reasons why, but there are some good reasons, for the probate side. But the other thing to keep in mind too, you do not have to have the trust exist today to have it be the owner of the policy. In fact, we usually don't recommend that you have the trust be the owner day one because sometimes it creates a bit more paperwork for the insurance company, but you can change the ownership of the trust to the trust. So think of a juvenile policy. Juvenile policy is owned by the parent, the child is the insured, and the beneficiary is oftentimes the parent. Now, let's say when that kid turns 21 years old or gets married, you decide, guess what? I now want to gift them the policy. So you change ownership from you to them. So now they are the insured and the owner of their own policy. And then down the road, guess what they can do? They can change the beneficiary to their own kids. So that it can change over time. So keep that in mind. So once again, the beneficiary of a policy can change over time, and so can the owner of the policy over time. Yeah. Yes, do not rush trusts. I have a client right now that's working with one of our people. He paid $10K. So Chris, you'll love this one. And Steven, he paid $10K to one of these flashy people on the internet to have a trust set up. And I looked at it with him and I said, hey man, this is not advice, but I think you just gave ownership of your assets to the trust that you don't own the trust. You don't control the trust. Your parents do. So he literally had given away his assets, his home he lived in, to the ownership of the trust, and he was not the owner of the trust. He didn't run it. Or he ran it, but he wasn't the owner. So if something happened, he would lose those assets. So right now, obviously we know who it is. Brent is now unwinding that whole trust because of how it was structured. So one, having the right person set up the trust is extremely important. And you understanding how it works is also very important. But yeah, if you ever see someone online charging a huge amount, like 10 or 15 grand to do all this crazy stuff with this trust, to hide money, avoid taxes, run the other direction. Just run the other
Brian,
direction.
I can speak firsthand. If anyone ever tells you that the trust structure and what they're setting it up for is primarily tax savings or anything to do with taxes, you got to go the other direction. I spent over 90 grand creating my trust structure, and then I spent another probably 15 grand unwinding it, and a tax bill of well over 108,000 just because of the errors and the things that they did wrong. So folks, please let me be your guiding light in terms of somebody that has made the mistakes so that you don't have to. There are too many guru liars out there pitching these trust structures, these complex trust structures. My best word of advice is any of them that you're considering, hire a tax attorney, and a good one, to review all of the documentation. My guess, 99.9% of them, your tax attorney will tell you run the other way. It's the best money you'll ever spend. Get with an attorney that knows how to set the trust up and does it for the right reasons, which is typically estate planning, asset protection, or just purely family legacy planning. If the word tax or tax savings or tax avoidance comes in, it is absolutely bogus.
Yeah. I had a client the other day, by the way, said, "Oh, I'm doing this so I don't have to ever pay taxes again." I'm just like,
Yeah, somebody's going to jail there, Brian.
Yeah, that's a whole
Yeah.
world of hurt right there. Oh my gosh. It was,
Hey,
it
so
was scary.
So one thing I just wanted to kind of switch topics just real fast here, and we can get back to some of these Q&A. But one thing I did want to mention, and the only reason I want to mention this is because of the timing of it is very important right now. So in 2 weeks from today, we are actually going to be traveling on airplanes out to Dallas, Texas. We have a event coming up called the Private Money Club Money Tank. But let me show you kind of some of the things we're going to be talking about there, because we're opening up Money Tank, going in depth on how to use the infinite banking concept and becoming your own banker in investing. Like, that's what the entire event's about. So let me just show real fast, if anybody can make it there in 2 weeks, I'll give you guys a discount code too to get a ticket, because we do have a few general admission tickets left. But this is what we're going to get into a little bit. So these are some different topics during those 2 days we're going to be covering. So all kinds of different active real estate opportunities, everything from wholesale deals to development deals to flip deals to mobile home parks to note investing and everything in between. We're going to be talking about some assisted residential living properties, commercial property. We're going to be talking about private funds. We're going to be deep into the passive side of real estate investing, which is what Private Money Club is all about. You'll meet a lot of business owners there. We have a couple stock gurus that'll be there. We have experts in oil and gas, movie production, solar energy when it comes to especially tax credits and saving right there. But we're going to be talking about all this different stuff at Money Tank. And let me just kind of give you a quick example of what this does. So I mentioned compounding interest earlier, but number two, just as important to taking advantage of compounding interest, is always keeping your money moving at all times. And one of the beautiful things about what we do with these specially designed whole life insurance policies is it gives you the ability to put your money into a vehicle that uses both of these two laws simultaneously. So remember, all the money you put into the policy, that cash sits in that policy, compounding, guaranteed, tax-free for the rest of your life. Guaranteed, contractually speaking, it's guaranteed to grow for the rest of your life and compound. That's just the way it works. But simultaneously, you can also borrow against that policy to use that money. And that's what we talk about, paying off debt and the rest of it. But what we're really going to get into at the Private Money Club Money Tank event in Dallas is how to simultaneously take that money out of the policy and then get that money moving for you to make more money, because money in motion is always making more money. Money sitting still is going to lose to things like inflation. So we want to get that money moving, and that's what this 2-day event is all about. So let me just give you a quick example of what this could look like. So this was a policy I designed for a young lady a few years back. She was a real estate investor, put $150,000 into it the first year. Remember how Brian talked about we can put larger amounts in the first year? We call it a dump in, and then however much annually moving forward you want to put in. And keep in mind, the minimum on this policy annually is $17,500. So her range and flexibility is anywhere from $17,500 up to $150,000 the first year and $50,000 in those subsequent years. So in this case, though, she puts $150,000 in the first year and then $50,000 a year after that. So let me just show you what this looks like. So let's say that she started this policy 8 years ago. She's been doing active real estate investing, growing her assets, and maybe the market has been appreciating. And now she's ready to transition away from active real estate investing to more passive investing, things like private money lending. And is there anybody on here that's done that already? I know, Chris, you do a lot of this. Brian, you've done a lot of this, but you guys started with a lot of flips, maybe rentals, active real estate deals. And over the years, you sold some of that off and you transitioned, and now you're doing more lending on direct deals. You're doing lending to funds, to these different types of opportunities. Is anybody else like that? I know we do that ourselves. But anyway, so let's say that she does that for the first 8 years, and then she wants to get into private money lending. So let's just see what this looks like. So in the 8th year of this policy, her cash value within the policy grows by $66,722. Okay, but to have that growth, she injected $48,593 of premium deposit into the policy that year. So she puts in 48 grand, the policy grows by 66 grand. So that's a $18,000 growth inside the policy that year, or a 37% cash on cash return. So not bad right there, considering that's all tax-free growth within that policy. And she didn't do anything different 8 years prior, except change one thing, which is where her money goes first. Her money flows into her banking system, this whole life policy, as opposed to Wells Fargo or Chase Bank or Bank of America or the rest of them, okay? She made that one change 8 years prior. Now, let's not stop there, because remember, simultaneously, now we can pull that cash value out and put it into investments, keep our money moving. And that's exactly what she did. Is she went through Private Money Club, found a private money loan at 12%. Okay. Now, if she went to Bank of America, pulled the money out of her savings account and lent it on a private money deal, what would happen? Well, she would earn 12% on the private money deal. She would earn 0% in her savings account because she took the money out to do the private money deal. Well, here's the difference with your own banking system. With this system, when you pull the money out, the money stays in there compounding and growing for you. So she still made the 37% that year in her private banking system. She also made 12% on that private money loan. Now, she did have to pay the insurance carrier 5% that year to use that money. So let's do the math. 37 plus 12 minus 5 is 44% return. So which would you rather have? We didn't do anything different except where the money goes first. Would you rather have a 12% return on your money or a 44% return on your money? And at the end of the day, it's as simple as that. So we're going to spend 2 entire days in Dallas, Texas, in 2 weeks from today. It's the May 8th and 9th. Chris will be there. I know, Brian, you can't make this one, but we're gonna have 20-some people there from our team, 100 or so different clients and students and members. So it's gonna be an incredible event. So I'll put the details over in the chat box for you guys, but I'd love to see you there if you like the idea of what I just showed on the screen.
Hey, one other thing too, Stephen, a lot of people are saying that they can't make it, one reason or the other, caring for loved ones. I love what Deborah said. That's amazing. But, one thing we're going to be having, and I believe it's next week, Stephen, I'll let you confirm, we have virtual tickets. So we also are going to be streaming virtually. So if any of you can't make it, but you still want the recordings or you want to join us virtually, we will have those tickets and they will be available. Stephen, when will that be?
Yes, May 1st is when the virtual tickets will come available. So yeah, we had a lot of people reach out to us, and we had done virtual in the past, like a hybrid event, and it's so much better being in person because that's where you really break bread and have drinks and you get to know each other and see each other, look each other in the eye. But I understand that people do have other commitments, things going on. So we decided to open it up, and we're going to definitely do the virtual. So we'll get tickets for sale May 1st. So starting May 1st, just keep an eye on your email and or join us another one of these webinars, and we'll make sure we share the link to get virtual tickets. I believe they're going to be $97 too, so very inexpensive. But with that said, I do want to give everyone a discount code, so I'm going to put that over in the chat box. So if you use discount code Premier200, it'll give you $200 off general admission ticket if you want to join us in person for Dallas. And I believe that discount's good for today. So I would go get your ticket now if you can. All right, cool. All right, any good questions come in?
Oh, there's a whole bunch of them. I'm trying to keep up. Brian, I know you're over there aggressively answering them, so I'll let you guys answer questions. You mind if I just show off Vivi Lucky Jeans? I think this is right in line, folks. You know, I've shown this before, but I just want to show it again. This is the very first policy that I did for my daughter, Vivi. I set this policy up, me and my wife, when Vivi was 6 months old. You know, so a lot of people are asking how young can you do it? You can do it when they get their Social Security card, but I delayed and did it after 6 months. And it was a small policy. I put $5,000 per year into it. This policy is a Mass Mutual policy, but we have since added another policy for Vivi for just over about $8,800 a year, and that one's at Guardian. But here's how effective a policy is for a child, especially a young child. The goal for Vivi was to set her up with her banking system so that she could fund all the things throughout her life that she would normally have to finance through a bank. So if we kind of look at this, and also I want you all to know this policy is not built for maximum high early cash value like we would do for most of you. This policy is built to be a monster in the later years, because I didn't plan on using Vivi's policy in the early years, because I mean, what am I going to do? Take a loan from the policy to buy some Paw Patrol toys? I mean, that's not a lesson to teach her, right? When she starts getting into things like dirt bikes or four-wheelers or cars, that would be when I can start teaching her. So as you can see, by the time she gets down here, when she's roughly around 18 years old, she's going to have $119,000, which we would then use for college. Now, this is not adjusted for inflation, so please don't beat me up. At the time when I did this, I said, all right, 20 grand per year for college. That'd be 80 grand, you know, that she would take out. So we take the money out of the policy and loans. And I also want to be clear, this policy example is not how we would use it, because I'm showing zero money being recaptured and recycled into the policy. This is literally like the worst case ever, because all I'm doing is showing taking loans and never repaying the loans in the policy. So I want to be clear about that. So we fund her college. Then we figure she's going to get married. So at 29, we take 40 grand out for a wedding. Then we take 60 grand out shortly after that for a house down payment. And again, the order in which these happen doesn't matter, because listen, at that point in time, she could probably buy a house. She's got $334,000 earning interest and dividends, of which she has $154,000 available. So I just show her taking a deposit. I was trying to be realistic in this example. Then Vivi has kids. So then she takes 30 grand out each year for her kids' college. Again, if some of you are like, oh, college will be 100 grand per year. Well, it won't matter, because Vivi's got 685,000. So that's plenty to cover whatever college costs would be. And then I have Vivi retiring here at 64. Again, could Vivi retire earlier? Vivi could retire at 50 or 55. It doesn't matter. I just had to pick a date. So here she's got $1.9 million at 64, growing with interest, okay, and dividends. She's got $1.55 million in cash value after all of those loans were taken out for the colleges, the house, all that other stuff I mentioned. And then she begins to take $90,000 tax-free out of the policy all the way until 90 years old. Then actually I got it going beyond 90. I got it going actually to 99. Okay, so if she, at 90 years old, I just cut it there. At 90 years old, here's the summary. She and, you know, mom and dad plus Vivi, because she continues funding it in her life, put in $398,000. That's the total amount of premium deposits all the way through to age 90 that she's put in. Her total loans that she took out up to 90 years old are $2.73 million. Her cumulative cash value that has been earning interest and dividends at 90 is $5.5 million plus dollars. She has a net cash value of $2.9 million that is still just sitting in cash value that she has not used. And her net cumulative, I want to repeat, cumulative return is 738.41%. This is one policy for my daughter that we set up at 6 months old. And this is just the first of what will be many policies in her banking system. So why should you start a policy on your child? That better not be a question that goes up into the Q&A. The proof is in the pudding.
That's an awesome segue to that. And that also, then you didn't even talk about the death benefit that's still there too.
It was millions of dollars. So at age 90, your death benefit's $4,042,000. It starts, the death benefit starts at 6 months old at $1,073,000. So you can see, contrary to what Dave Ramsey always says, oh, your face amount and your cash value does not increase your death benefit. The heck it doesn't, Dave. Right there. The reason the death benefit starts at $1 million and ends at $4 million is because of the cash value, not directly. We're not adding the death benefit plus the cash value, but the cash value drives a dividend. The dividend then drives paid up additions, which increases the death benefit over time. I know that's too complicated for Dave Ramsey to understand, but you can't always believe what the gurus are out there saying. All right, Brian, bring us home, and look at that. We are finishing dead on time.
So guys, once again, it starts with you. What we're all showing you on these pages and what we're seeing here in the chat box is because somebody started. So when it comes to generational wealth, it starts with you. If you have kids, grandkids, even yourself, once again, make that decision. How do you get to the top of the mountain? Stop walking around the mountain, take the first step to climb the mountain. So once again, just like what he just showed you on with Vivi, I mean, anybody can do this. Just got to get started. So guys, appreciate all the questions. Loved all the comments and stuff. I love seeing some familiar names from yesterday, by the way, too. Hey, Frank, there you go. He's on yesterday as well. But yeah. And yes, Paul, this is being recorded. It'll be in the YouTube channel. I think probably this weekend sometime. Usually it gets put into the Chris's YouTube channel. So
all right, cool. All right, awesome. Mr. Fouts, thank you. Mr. Naugle, thank you, sir. Appreciate everybody being here. Wealth webinar. We'll see you guys same place, same time next Wednesday. And of course, join us for the rest of our weekly shows every Monday, 1 p.m., Money Club Mondays, every Tuesdays, Take Back Control Tuesday, 3 shows every single Wednesday, including the one coming up in about an hour, 2 hours from right now called Ask Me Anything Happy Hour, where we have a Brady Bunch style on the screen and we answer questions for an hour straight, have some fun, have some drinks, things of that nature. And then every Thursday for the Private Money Club Quick Start webinar. Hopefully we'll see some of you guys live and in person in Dallas, Texas, 2 weeks from today. Appreciate everybody being here. Have a great week. Thank you all. Bye.
Bye, everybody. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.